Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Jerry Randall, CEO of Venture Life Group, a leading OTC consumer healthcare business. So welcome, Jerry.
Hi, Paul. Nice to talk to you again.
Yeah, well, big congrats on this morning's positive first half results and in-line guidance for the rest of the year. But before we sort of dig into the details, I don't suppose you could quickly give us a bird's eye view of the general health of the consumer in light of the sort of cost of living crisis.
Yeah, I mean, I think for sure consumers are feeling the pressure. Obviously they're going to see interest rate rises may affect some mortgages or not, but we're seeing it in heating. We're seeing all the electricity there. I mean, at the moment, we're not seeing any impacts on our products on consumer demand, consumer appetite. Many of our products are need state products, so it's a condition you've got, you need to treat it. So I think there will be more pressure on the more I suppose discretionary spend, whether it be clothes, white goods, luxuries, that sort of thing. But certainly from a consumer products in the healthcare space and need state products, we expect that to remain reasonably robust. And certainly in the UK, a lot of our products have got a good underlying core of loyal repeat buy customers. So we think that'll hold up reasonably well. But let's see how severe it is for the next year, really.
Well, that resilience has certainly sort of played out in the first half, and let's just turn to sort of the quick highlights of results. And just sort of like looking top level, it seems like the acquisitions have really sort of like been successful and almost delivered sort of like 10% like-for-like growth, which seems to have really improved the margins. If you would just take us through how that sort of like whole sort of mix is working.
Yeah, sure. So obviously we acquired the BBI healthcare business in June last year. So we had it in for the whole of the second half last year, but very little of the first half. So you're seeing the impact of those coming through. Really pleased with the organic growth. We're seeing it, across all of that range. Lift has done really well. Lift is growing very nicely. Balance Active, internationally, we had to stop supplying to a customer who was selling to Russia because that was a policy decision of ours. Outside of that, the brand's still performing and still growing. And with Lift, even with that growth, we haven't particularly invested behind it a lot at the moment because we're doing a lot of research into how much of those products are bought by diabetics, how much is bought in the sports market. But that will dictate and, if you like, shape what we do next year. So very pleased, integrated well, products selling well, and 10% organic growth. Very happy with that.
And the margins, the mix seems to be really being driven, doesn't it? Because you've now sort of flipped into sort of like your own brands, which account for more than 50% of turnover. And that sort of like helped drive the product mix. And I think your gross margins were up, was it 4 or 5% of the
5 percentage points, yeah. And most of that's driven by that higher margin acquisition that we've made. We've had margin protection policies in place, so we're passing on those increases in raw materials and packaging. We can't pass on the energy increase. That's an overhead of the factory, and we can't pass that on. But anything to do with individual pricing on components or raw materials, we passed on. That's being balanced out. And then what you're seeing is that improved gross margin from higher margin branded products, plus general improvement in volumes coming through.
And then on the third party products that you sell, and is just for investors, I'm guessing, do you actually manufacture most of those, if not all of them as well?
Yes. Yeah, we make that. There's a very small amount that's outsourced. We have some wart plaster and a couple of capsule products that we don't make ourselves. The Lift brand, which is obviously one of our brands, not the custom brands, but that's outsourced. But we're looking at bringing that in. It's a food supplement. But all of the custom brand side, like I say, with the exception of a handful of small products, are made in by Cosmos in Italy.
And those third-party products, how did they fare in the first half? I mean, obviously your own brands or the ones you acquired did very well, but what about the sort of third-party ones?
Yeah, very good. We saw 3% growth in the customer brands, but what you will see with a strong order book is a very strong second half coming from the customer brands. So we've encouraged customers to order further ahead. So it doesn't mean bringing their order earlier, it doesn't mean that they're bringing revenue forward, but to give us greater visibility and to allow us to buy the inventory, firstly, to make sure we can get it, because that's been a big issue this year. Can you get the raw materials or the packaging? And secondly, to lock in the price so we can confirm, because when customers give us orders now, what we're saying is we'll price that order, we'll look at what we've got in stock, what we have to buy, and then go back to them and say, look, this is the increased cost. You have to pay that. And all the time, the biggest worry for them is availability, not price. So almost without exception, they're saying, yeah, that's fine. We'll pay the extra because we want availability. So that's the biggest overriding demand from customers is availability now, and not so much price. So yeah, that's why we built inventory. So inventory is up a couple of million compared with the start of the year, but that allows us to lock in the price and also to make sure we can deliver.
And what would happen if, say, just hypothetically, a customer sort of like struggled to sell and basically, wanted to cancel the order? I'm guessing because they've underwritten the actual purchase, then, they'd have to take it, I'm guessing.
Yeah, and we've got a very much a sort of 80-20 rule in terms of our partner business, that 20% of the customers deliver 80% of the revenue, all long-term partners, a couple of new ones, but generally long-term partners with a long-term trading, regular ordering patterns. So when they order, that's a committed purchase on a confirmed order. So we've had no issues with bad debt in the past, no issues with cancelling orders. Occasionally, they might ask to move an order further back or even further forward. But once they're in, they're covered. And if we once we get an order, we then place, buy the inventory if we haven't already got it. And sometimes it makes sense to buy more of that component to make sure we lock in the price. And if that's the case, again, we get the customer to underwrite in writing that they're going to cover the extra cost of additional stock that we buy, so they can make sure that they retain the price benefit for the future as well. So it's that's how we deal with it.
Right. Okay. Just for sort of like, again, just a bit of clarification for investors, what is actually in sort of legacy? I know you mentioned it in the RNS, etc. What are the legacy products?
Yeah. So what we're saying is everything we had before we bought BBI and Health in Spain.
Oh, I see. Okay.
So that includes Ultradex and Dental and Proctoise and a number of other products. So really it's just saying the business before we made those two acquisitions last year.
Right. Okay. So they're not really legacy products. They're your non-recently acquired products. That's really what we're mean.
Yeah. Legacy is easier than saying products acquired, products owned before we acquired.
Yeah. Okay. Gotcha.
But the legacy products have generally been flat year on year in this first half, but second half we'll see good growth from them because that business is traditionally weighted a bit more in the second half. Not so much the UK sales, but particularly the international sales, just through ordering patterns and when customers have ordered before.
What about the sort of Chinese partnership? Because that seems to have obviously, we've had continued ongoing lockdowns in places like Shanghai, in fact, all over China, I think, to a certain extent, which has been unfortunate because it's sort of impacted offtake. But hopefully now President Xi at his October People's Republic conference will actually give the green light for the lockdowns to end.
I hope so, yeah.
And presumably then that will act as the sort of the catalyst to real get some volume in, because it was selling pretty well, the oral care in China, wasn't it?
Particularly dental, we know that when that's marketed, it sells very well. It's an effective product. Oral care is really poor in China, so there's a real sort of push, particularly for that sort of layer of the population at the top who aspire to live a Western style lifestyle. So we know it sells well. I think there's two things when there's a lockdown. There's obviously lack of people going to shops, but then people say, well, can't you buy online? Well, you can buy online, but you still need delivery people to deliver it. You still need to be able to get it out of the warehouse. So the lockdown has impacts in both of those areas, not just consumers buying, but companies moving. So we shipped stock out to China in the first quarter, but of course it arrived and went to lockdown, so they couldn't move it out of the port. We all know about Shanghai port being clogged. But now that's out and they're starting to sell. So we still think the long-term future for China is very good. But obviously, while these zero COVID lockdowns happen, it really does play havoc. And so, for us, we've got a good partner there. Obviously, they ship into China and they're having difficulties with these lockdowns, but they're starting to sell, starting to grow. And I think long term, it will be a positive outlook in China for our products.
And then just sort of like a bit closer to sort of like on the timeline, etc. It's the second half. I mean, how's Q3 sort of trading been? I mean, you did mention in the RNS your order book was up, I think, was it 30%? Was it sort of like year on year?
Yeah, and the order book's up for two reasons. So the bit we're talking about there is, if you like, the growth part of the portfolio, because the other thing, as I've already mentioned, is we're getting customers to order further out. So when you factor that in, the order book's even bigger. We've only talked a bit about the growth part. And that growth obviously only applies to the part where we're meeting orders, because in the UK, 30% of our business is in the UK, and that's bought weekly by Boots and Tesco. So we don't see a long-term order there. But the other 70% of the business, that's where we're seeing that increase in growth. So that's why we can be comfortable. We'll deliver our numbers for the year end, and then on top of that, 20 or 30% of that order, but we've got more, which is the further out ordering, so giving us greater visibility.
Yeah, I mean, if it's sort of like 30% up from last year, I'd have to quickly work out the actual numbers. But what did you do in the second half last year in turnover? Because I'm guessing.
So what we did in the first half of this year was the same as we did in the second half of last year. So
that's what I thought. So 19 million. Okay, right. So, and I think just for investors, Singers are sort of like forecasting 40.5 million pounds in turnover, and you did 19 in the first half, which leaves just 21 or so in the second half. But yeah, if you've got a 30% increase in your order book, that gives me.
It's not 30% on 20, because, as I say, some's in the UK.
Yeah, okay.
But it's 20 to 30% of the balance. But I think what's really important to understand, and just going back to those consumer behaviours you asked about earlier, what we are seeing is that consumers are moving more towards the discounters. Yeah. In terms of where they buy things, so still trying to buy the same brands, and buying them in the discounters, the sort of M&amps, the Aldis, the Lidls, Wilko's, that sort of thing. So we're now opening up distribution in those stores for some of our products in the UK. So what that will do will be slightly lower price and lower margin, but gaining volume. I think also what's important to recognise, in the second half, there's a bigger customer brands part to the business, because it will be bigger again in the second half, slightly lower margin. And whilst we can pass on packaging and raw materials increases, we can't really pass on energy increases for heating the factory. So what you'll see is a sort of improvement in volume, maybe a slightly attenuation in percentage margin, but good strong maintenance of the EBITDA pound notes.
Right. And then just in the sort of the cash position, etc. I mean, your net debt's probably pretty flat compared to December at the end of last year. But that's not because, I mean, you were generally generating quite a lot of cash flow. You just obviously invested in your inventory. But if you look sort of like further out from this year, and that sort of the supply chain normalizes, you should see that sort of like convert back into cash, shouldn't you?
Yeah. I mean, if you look at operating cash flow first half of last year compared to first half of this year, we had a negative operating cash flow of just under £1 million last year, positive of 1.4 million this year. So that's a 2.5 million swing just in the first half. And that includes the, taking account of the additional inventory that we've purchased. So, operating cash flow before working capital, very strong. And then we've invested a couple of million in inventory. So yeah, absolutely. We see that going forward. Now, I think, perhaps if we'd have spoken a few months ago, I would have expected the inventory to unwind slightly in the second half, but we've continued to see that ordering going on from our customers, continuing to order forward. So we'd expect our inventory position to stay the same the second half of this year, but still generating cash from that profitable revenues and operations that we have.
And so if we sort of again push the clock forward sort of 6 months, and we'll hopefully get into sort of like a net cash position, say March, July time next year, etc. And you've got the RCF facility, which is what I think 30 million, plus you've got a sort of like an accordion facility on top of that as well. How are you going to deploy these funds? I mean, obviously, you must be sort of like licking your lips, because obviously a lot of businesses now, their valuations have significantly reset.
Yeah, I think there's a general understanding of more realism in valuations. I mean, we are, as you know, we're a buy and build business, as well as delivering, more than 10% organic growth every year for the last 5 years. We've been buying and supplementing that. So there are some nice opportunities out there. I think, you have to be cautious, of course, in the current environment. Interest rates are rising. So you have to be cautious, and that you can take account of, movements in the market. I think the volatile market we've had for the last few years, that's not going away anytime soon. And I don't just mean the stock market, I mean supply chain and everything else. So, we've adapted ourselves really well to operate in that environment, to be robust and resilient. And so we have to be mindful of that. But there are some really good opportunities to buy products. And I think use of debt, we're absolutely fine with, but it has to be at sensible levels, below 2 or below. and it has to be mindful of perhaps interest rate movements and making sure you can cover that. So as long as you're comfortable with all those things, then there are great opportunities and more realistic prices. I mean, we comfortably see opportunities well below 10 times EBITDA, in the sort of 6 to 7 times EBITDA for, profitable growing assets. So, for us, it's a great opportunity, mindful of managing that future volatility.
Mm. And you're in a particularly good position there, because not only when it comes to sort of like, you're tried and tested on the sort of the integration process, you have a pretty good blueprint of how to bring these businesses on board, but and put them into your distribution system, etc., which is obviously pretty much global. But also you've got quite a lot of available manufacturing capacity, which not only, because most synergies usually come below gross margin, but actually you're going to get quite a few up in your cost of sales as well, I guess.
Yeah. I think, obviously as we increase throughput, we're only running at approximately 50% capacity across our both sites. It's a bit less spare capacity in Italy, but a bit more in Sweden. I think the other thing that is important, people know we're investing at the moment in automation of the production facility. So we're conscious that we haven't seen huge pressure on labour costs yet, but I think that will come. Everybody's going to see that pressure. So we're looking to automate a bit more in Italy, and that means reducing the labour cost impact and cost of sales, speeding up throughput and efficiency, running lines faster. But what it doesn't mean is we're not, won't be reducing the people in the business, but at the top end, we have a flexible workforce where when we have busy times in the factory, we use external contract labour in there, and it means we'll reduce the use of that because we're increasing the automation within the factory, which will improve cost of goods, improve line speed, and improve efficiency. So that, on top of growing volumes, will really help to push our gross margins going forward.
And then, so just pushing the clock forward, just ultimately, if you can manage to sort of like, do double-digit organic growth on a sustainable basis, where would your margins be if you do get that operating leverage coming through your manufacturing facilities? Because I did see your EBITDA margin, like your gross margin, ticked up at the half year. I think it was at 17% now from about 14%. Yeah. So where would you like to see? I mean, obviously as high as you can, but realistically, where do you think you could get to?
There's no doubt everybody's gross margin's been impacted over the last year by those supply chain, and I think where we're going to finish gross margin will be percentage will be slightly lower because of the improved customer brands business, but also those energy pushes. But nevertheless, we're improving in terms of volume and throughput. I think ultimately we should gravitate up towards mid-40s and ultimately up towards the 50s as we acquire brands, because the brands we acquire are all higher margin and therefore they're contributing overall. So I think our aim would be ultimately you should be running a business at a 45 to 50% gross margin with a 20 to 25% EBITDA margin. And, those are going to be achievable, in the medium term for our business, I think.
And would you ever go sort of like D2C at all, direct to consumer, or is it basically because your niche brands are sort of like relatively small, it wouldn't be worth doing a sort of like a separate D2C offering?
I mean, we do a little bit of that at the moment because we obviously, in the UK, we invest in marketing, which is all digital now. We appointed a new e-commerce manager this year who's now heading up that strategy, but we sell through Amazon. So we don't have our own D2C platform, but we use Amazon in some cases as Vendor Central and other as Seller Central. We just launched in Amazon Germany this year, the Balance Active product, and that's only been going for 7 or 8 weeks, but already really good traction going on there. And I think going further ahead, yes, we would look to see where it's appropriate to have our own D2C presence. Probably not in the UK, but because we have a lot of good retailers here, but potentially overseas as we grow out main European markets where we haven't got those same retail relationships, it may make sense to have our own D2C platform.
Correct. Great. Okay, brilliant. Well, just before we sort of wrap up, what's sort of likely news flow over the next sort of like, I don't know, 3 or 4 months? I'm guessing there'll be a trading update in January at the end of the financial year.
Yeah, that's correct. Yeah. So, obviously we're looking at M&A. I can't sort of comment on where that is or how it is, but we're still keen. But again, working within that, sort of leverage measure that's going to keep shareholders happy. But there are great opportunities, and it's important we take hold of those. You'll remember from earlier in the year, we noticed that 2 of our non-execs were stepping down. So you'll see the appointment of 2 new non-execs, not too distant future. We've been working on that. You'll see gaining of new partners abroad. You'll see updates in terms of where we're launching, where we're gaining distribution. We're gaining distribution even in the oral care brands. So we've retained all the distribution we've got and more. And then in January you'll see our order updates. So good news flow, interesting, and very comfortable and confident with the rest of the year.
Brilliant. Well, fantastic to hear that at least one consumer company is knocking the ball out of the park or are doing very well. So well done again, Jerry, and look forward in touching base later in the year.
No, you're welcome, Paul. We've got a great team. They've worked really hard, and these are the results. So thanks. Always good to talk, and look forward to the next time.
Brilliant.